Fact. All right. So, good evening, everybody. You are welcome to day 3 of our boot camp. My name remains Philip with the double L. You are welcome to our boot camp. Thank you for joining from day 1. Thank you for taking out time, your patience. Every single thing is appreciated. You are welcome. So today we are going to be looking at some interesting topics like I posted in the boot camp group. We are going to be looking at a whole lot of stuff. And the fact that what we want to cover tonight is quite broad and we have limited time. And I think we all agreed on Monday that anywhere we stop or any day, we are going to pick it up so that we don't rush things and we can deliver to you our best and within the short period of time we have. Trust me, anytime we're on calls, training or doing anything, sometimes we are there for 3 hours trying to learn some things. Our weekly outlook is always a blast. We spend as much time as possible trying to check the asset. But because this is a boot camp and we are considering people's data for streaming, Zoom consumes a whole lot of data, we understand, but this is knowledge. So knowledge, you have to put in all of the sacrifice that is going to be committed or needed from you. Having said all of that, I'm grateful. So tonight, after the psychology call, my first educator is going to be coming on board. His name is Fortman. He's tall. Yeah, very tall. Emphasis on tall. It's tall. On fire. So the idea now is we have two educators on ground today. But I don't know if Fort will be able to finish all of his topics, all of his section tonight. That's because we want to make sure we are ending this call in the next 2 hours. So by 11 o'clock, we want to make sure everybody is out of here. Well, yeah, someone said we don't mind the 3 hours call. I understand, but then we have to consider other people as well. We don't mind 3 to 4 hours. No problem. But then, okay, so Ford said he's going to be taking us the whole 2 hours tonight. I told you, he's my coach, he's my mentor. He's ready for you guys. So he's going to, wait, I'm being recorded, right? Yeah, so I need to compose myself because I'm going to YouTube. But then, the idea is just trying to make sure everywhere is lively and nobody gets dull and nobody sleeps on the call like, excuse me. So now tonight, what I really want to talk about, because thinking over the day what I could talk about during the psychology calls, during the psychology section, there are so many things to talk about. But I think something that really kept on ringing in my mind is the fact that is the question, are you coachable? Are you coachable? I think that very thing kept on ringing in my mind, kept on playing out in my mind, like question kept on popping up and I said, okay, so I'm just going to talk about this tonight. So the question I want to ask every single person here tonight is, are you really coachable? And this very word, are you coachable, question, I got it from one of my mentors, Kelvin Tradu, one of the elites, one of the top guys in the world, put across one of his teachings on psychology. And his very tip, the first thing he was asking was, are you really sure you are coachable? A lot of people want to advance in life. Let me use that word, advance. But the idea now is, you see, before we got here, there are some people that have been on the stage handling those stuff. And if you are going to be taking over from them, they need to, that person that is on the platform or on the stage has to pass a pattern to you for continuity. Before a person can pass a baton for you, he must entrust or he must be sure that you are trustworthy enough or you have actually gone through all the training for you to handle that level of stardom or that level of fame. And that person will not have that kind of trust if he personally has not been involved in your coaching. So the question will keep on popping up to you is, are you sure you are coachable? If you are coachable, how coachable are you? Because there are certain people that they don't understand that when we talk about being coachable, your decision most of the time, or your desire or choices most of the time, is not really meant to be in play at all. It's not meant to be in play at all. You have to follow the predefined pattern of how. Take for instance, and I'm going to be making some few illustrations tonight, and I'm going to be starting with, let's say, Forex now. Let's say you are on the chart now, you are a simple person, you trade support and resistance, right? Because I think a whole lot of people trade that. So now let me say what we have all learned from support and resistance is this place right here, or let's say this area right here, is actually some kind of resistance, right? Now, just imagine that they tell you that the person that is teaching you how to trade now tells you that this is resistance, and you say, oh no, it's not resistance. I decide to call it support. And it is not support, it is resistance. Now, give or take, let's say accidentally you happen to find yourself in that person's trading signal group, and it says you are going to be selling at a resistance point, and then you have already said that is a support point. That means automatically you are going to be making so many mistakes because you just made the biggest error of your life by saying you want to call it what you decided to call it. So the question is, are you coachable? Are you really coachable? Are you coachable? Another illustration that stood out to me again is the game of basketball. I don't know how many people play basketball here. I think in recent time I've been falling in love with basketball. In fact, I'm watching a series, and in the series, the world coach still struck out properly. You just imagine your coach trying to tell you that this is how to shoot the ball, this is how to run around the pitch, this is how to play a point guard, this is how to get a 3 points, and then you decide that no, you are not going to be doing that. Or they tell you it's a basketball and they say you have to use your hands to play, and then you decided that okay, if I want to play I want to shoot my own 3 points, I'm going to kick it with my leg. Trust me, that means you are not coachable. So give or take, every single person in life needs a coach. I think in recent time we've changed it to need a mentor. So do you have a mentor? How reliable is your mentor? What is what is the result of your mentor? Does he have proven result? Does he have proven strategy? And I'm not talking about this trying to say probably maybe after the boot camp you should make sure you sign in for our mentorship classes and all of that. If you want to sign up for it, it's fine. If you don't want to sign up for it, it's fine. I'm not trying to cajole anybody here. This is a free boot camp, and I'm not doing any of that. But the idea is, don't let the points get lost on you, is, are you really coachable? Do you have a coach that you are willing to submit on that to take you on this journey? I think while I came into the training game, there are some people I signed up under, and you were just so far away. You had questions, and then you ask them the questions. There's nobody to answer you in real time. You send them a message today, they are answering you in, let's say, a 1 month's time, where you've blown a whole lot of your accounts, you have wasted a whole lot of your money. They really just don't care about you. They just want to collect your money and then up their own game and all of those things. And all of this kept on eating me from one group to another group until I met my own personal coach. God be praised. Tony Blair. Trust me, I met Tony, and the game just changed. He was so available, he plays around with us. Sometimes he will tell you that it's about traveling early in the morning, and then at midnight he's available for us on the call, and then no sleep. I'm not trying to sing. He will not take his nap. The next morning is at the airport trying to give assignments. Weekend is checking up on you, trying to say, how is your trading going? What has the issue been? Trying to just always looking out for me. And not just me, a whole lot of us, a whole lot of us. Trust me, that's the kind of mentor you want. When you have that kind of mentor, I want you to know that you must submit to that kind of mentor. You must allow him, you must sacrifice the time of allowing him build you on that journey. So tonight, guys, I want you to really sit down and think and really start examining your life and your career or your path in life. Do I really have a mentor? Not just in Forex, in every area of my life. Do I really have a mentor? Do I really have a coach? Because give or take, we are not getting younger anytime. We are not getting younger. We are getting older, and give or take, in real time, we are going to be settling down, and then a whole lot of responsibility is going to be coming up on us. Yeah, we already have some, and more is going to be coming up on us. You really have a coach. You really have a mentor. I believe you understand what I'm trying to say. So after tonight's section, I want you to really sit down to really ask yourself, who is my mentor? Who am I really submitting to? My mentor, am I accountable to my mentor? Am I really accountable to him? Is my mentor or my coach really worthy of being my mentor or my coach? Questions I should be asking myself, questions you should be asking yourself. So without wasting so much of your time, that will be my part for tonight's call. I believe you picked one or two from that call, and I didn't bore you. So if you're ready for tonight's call, can you drop something for me in the chat box while I try to pass it to my next host? Hotman, are you ready for me? Let me pause my music. Let me make Fort the host. Yeah. I see you higher. Yes, sir. No, we all are ready for tonight. So, where is the Fort? Okay. All right. So, Fortman, you are now the host. So you can, the floor is yours. Enjoy your stage. Enjoy. I'm all out of this place.
First off, I want to ask if everybody can see and hear my background song. I mean, I just have my speaker close to me playing sound. I love listening to your instrumentals, so I'm just playing one of those Chinese instrumentals. Yeah, can you hear me? If you can hear me, drop some ones in the chat box. If my music in the background is still loud, yes, let me know too. Share my screen. So I want you to let me know, is my background music too loud, and is my voice audible enough? So yeah. Is my background music too loud? Can you hear me? Please, I just need somebody to tell me if you can hear me clearly. Okay. Is it okay now? Okay, is it okay? Is it okay now? Is it okay now? Yeah, so okay, I'm just going to allow people on mute. I'll allow you to unmute yourself. Tell me if it's okay. So I'm just going to unmute one person, Abiola. I'm asking you to unmute right now. So please unmute yourself and tell me if it is okay. I'm also going to ask Alabilo Rudin to unmute. Tell me if it is okay. Ayo, my boss, what's up? Please tell me if it's okay. I'm asking you guys to unmute, please.
Okay, sir. Good evening, sir.
What's up, bro?
I can hear you clearly, sir.
How about the background music? Any other person?
Good evening, boss. Good evening,
Yeah,
boss.
sir.
I can hear you loud and clear, but you can reduce the background music a little bit, please.
Okay. Okay.
All right, sir.
Thank you. I think we can go ahead now. Yeah. So I mean, I love instrumentals. So yeah. Good evening, everybody. Welcome to the third day of the boot camp. Yeah, welcome to RBTM 301 boot camp. And my name is Fortman. Um, I'm sending you love all the way from Lagos. I mean, I can see about 67 people on the call, and trust me, you are really going to. I mean, from day one of the boot camp, we've been getting top tier value. I mean, top tier value. People are. Somebody said my voice is low. Yeah. Really? Hey, okay. Let me devise a means. Okay, is it better now? Is it better now? Is it better now? I'm very close to my mic. Very, very close to my mic. Okay, let's go. So, from the first day of this boot camp, we've been getting top tier value from every of the educator. And first off, I want to use this opportunity to shout out to our very mentor and Coach Philip, very humble. I mean, yeah. I mean, thank you so much, sir, for. Okay. Okay, yeah. Okay, thank you. So let's just go ahead. Yeah, so I really want to thank our coach, Coach Philip. Thank you so much. I mean, I owe my journey, my growth in the forex industry, trading in the financial market, the foreign exchange market, I owe it to God and to you. Thank you so much, for being there. I mean, you've been someone that we not just me, I mean, every one of us can reach out to, talk to, and we've seen the growth. We've seen the growth, enormous growth. We've seen it in its numbers. We've seen it. Thank you so much for pouring out yourself into us. Thank you also for, giving us this privilege and opportunity to be able to, pour ourselves into other people to, thank you so much for the system of continuity. I also want to use this opportunity to shout out to every of my brothers that are on this call, starting from Charles, shout out to you, brother. Then Ayo, Temitokwe, some billions, Emmanuel, if I don't mention your name, shout out to you, a big shout out to you. I mean, I really, really do appreciate every one of you. Thank you so much for the value that you have been giving. And a big shout out to everybody who is on this call. We have about 74 people that are on this call. And trust me, tonight, you are really going to be getting nothing but top tier value tonight. All I need from you is just to pay attention, get your notes, get your pen ready. And I'll be your pilot for tonight. And yes, fasten your seatbelt. We are in for a smooth ride. So I'm going to be giving us opportunities as the call goes on to ask ask questions as it were, right? So we're going to be starting now. Since we started the bootcamp, we've spoken about, what is Forex, market structure, discount and premium zones, discount and premium and discount zones and a whole lot. So tonight we'll be talking about, I'll be covering risk management. I'll be covering introduction to ranges. I'll be covering liquidity, why liquidity is needed in the forex market. I'll be covering types of liquidity, introduction to imbalance, and quarter points, right? So we are really going to have a lot of time. So I mean, we're really going to have a swell time together. So all I just need from you is just to pay attention and just take notes. So I'm really going to carry every one of us along and to ensure that nobody is actually lost. So the first thing we want to be talking about now is lesson 11, and that is going to be risk management. We want to be talking about risk management. Yeah, so So we'll be talking about risk management. So, and the way I want to talk about risk management is not going to be the conventional way that you've heard risk management here. The way I'm going to be talking about risk management is not just going to be the conventional way that we all know risk management to be. So I'm just going to be talking about, I'm going to be talking about some stuffs, and in the long run, I am going to as well just, we are going to do the maths when it comes to risk management, right? So risk management goes beyond the conventional wisdom when you talk about, the risk to reward, which is also very, very good, but, one of those things I want you to understand is that, when Forex trading, I always want to liken Forex trading as a man or a woman that has just been introduced into the School of Aviation. Now, when you're introduced into the School of Aviation, right, so you don't just become a pilot of the first day that you were given that book that is called Understanding Aviation. You are not going to become a pilot from that first day, right? So that is the same thing that applies to Forex. What are you going to do? All through your process in the School of Aviation, you want to give yourself some development time. You want to give yourself time. You want to give yourself time to really understand the basics. You want to really ground yourself in the foundation of Forex. And one of those things you want to learn on time is risk management. You really want to pay attention to risk management and understand it very well. Understand it very well, right? So, and risk management is really, really one thing you want to master early. Not just master early, you want to master it well. So, and one of those things I always say to people is that in trading, you just need two things in trading. Number one, you need consistency. Number two, you need money management. And in the long run, money management is going to do the lifting, right? So now when you talk about consistency now, we are still talking about risk management. And I told us that, from the beginning that the risk management call is not, this particular topic. I'm not going to talk about it in the conventional way, right? Somebody left a message. Is my rise? Okay, yeah. So let's go ahead. So just get your notes and your pen. I mean, trust me, I want to ensure that this is going to be the breakthrough you're going to experience that breakthrough you've been desiring in your trading journey through this call. So let's just go ahead. So one of those things I always tell people that in trading, what you need two things basically. Number one, you need consistency. Number two, you need money management, right? And I always say to them that money management is going to do the lifting in the long run. Money management is very broad. It is, it goes beyond, trying to manage try not to over leverage or trying to under leverage or something. Money management goes to, it cuts across maintaining your psychological capital, your mental capital as a trader, right? So because if you know how to do all the analysis and your mental capital is in shambles, you are going to have losing trades. You are going to have failed transactions as a trader, right? So in trading, you need two things. Number one, you need consistency. Number two, you need money management. And write it at the back of your notes that money management in the long run is going to do the lifting. So when we talk about the consistency, when people hear about consistency, it feels like, and this is one of the things most of the YouTube mentors, most of those guys on Instagram will not teach you, right? You'll feel when they say consistency means, you have to have winning trades every day. You have to have winning trades every day, right? So that is not true. What consistency means is that it doesn't have to be every day, but you are showing up every day and doing that. If the opportunity of what you have been taught shows up every day, you are going to be doing it the same thing. You're going to be doing the same thing every single day. So consistency doesn't really mean it has to happen every single day. But in the long run, when you check, you would see that, yes, I have actually been consistent. Not necessarily have to be every day, because somebody say, oh, why does it have to be every day? We are 75 people on this call, and in the long run, you will discover that most of us are not going to be swingers. We are not going to be position traders. We are going to be, day traders. We are going to be intraday traders. And as an intraday trader, you want to position yourself. You want to come into the chat every single day from Monday to Friday, 24 hours a week, 5 days a week. You want to look for trading opportunities. But I always tell people that if you're a day trader, day trading doesn't mean everyday trading, right? Day trading doesn't mean everyday trading. So when you talk about consistency, for the fact that you do not find a trade on Monday and Tuesday, but you found a trade on Wednesday and a Thursday and you didn't find on Friday, does that mean you're not consistent? That's not true. No, it means that you are just trying to position yourself. You're trying to maintain your, your psychological capital, your mental capital, manage your money properly. Because one of the things I learned first when I came into the trading industry was that, capital preservation is better than a blown account. Now, if you preserve your capital and you do not preserve your mental capital, I mean, you are still going to make a lot of mistakes. And this is one of the reasons why people quit. So when we talk about risk management for me, risk management for me goes beyond managing money. It goes beyond managing your equity in your account. It goes beyond managing your equity in your account. It goes even beyond, your psychological management. So when we talk about money management, I said something that money management is going to do the lifting. Yeah, money management will do the lifting in the long run. So money management talks about, it covers areas like, number one, it talks about your managing your money, like using stop loss. For example, now you will see a lot of traders on Instagram, Twitter, whatever social platform you are, and they'll tell you that I don't use stop loss to trade. I use mental stop loss. Let me tell you, if you are using mental stop loss is going to drive you mental. Right. So when you talk about money management, you want to talk about your stop loss, you want to apply the principle of compounding, and you also want to manage your mental capital properly. Right? You really want to manage your mental capital properly. So I know a lot of us, about 70 people on this call, everybody wants to get into the nitty-gritty. Guy, just go into the chart, show us where to buy, show us where to sell. Let me tell you, you are going to learn all these things, trust me. One of the plagues that that falls on a lot of speculators in the foreign exchange market is that everybody is trying to look for a system that works, a system that will keep making you money. And I'm submitting to you humbly that that is what you are going to be learning all through this bootcamp, right? That is all you are going to be learning. So, when you talk about money management, which is going to do the lifting, number one, it covers your mental capital. How are you able to manage your mental capital? Number two, following the rules of compounding, which is the eighth wonder of the world. And also, using a stop loss. Don't say as a trader, I'm using a mental stop loss. I said, if you use mental stop loss, it is going to drive you mental in the long run in your trading career. So you want to have a defined stop loss. You want to have a defined stop loss before coming into the market. You want to be able to prevent, you want to be able to, preserve your mental capital psychologically. You want to be stable, right? You want to be stable. And also you want to apply the principle of compounding. Now, let me say this, which is very, very important. And before we start doing the maths and get into other subjects, I'm trying to compress and manage time. One of the things that traders need to learn how to do is to limit their frequency of trading. Limit your frequency of trading. Now, as a developing trader, I tell people who are developing traders, we are not where we desire to be, but we are not where we used to be. We have been able to grow and develop over time, in the trading industry, right? So one of the things I also always tell newbies, who are coming into the Forex industry is that limit your trading frequency. I aforementioned that day trading doesn't mean everyday trading. Day trading doesn't mean everyday trading. So you want to be able to limit your trading frequency. You want to be able to give yourself to your rules. One of the ways you even maintain your mental capital is by adhering to rules. People come to me and say, if I want to quit my job, fourth man, I want to quit my job. I don't want to work under anybody. I don't want to work under any boss. I want to be a full-time trader. I just laugh. As much as it sounds good and amazing, but I just laugh. Do you know the reason why I laugh? People say, I'm going to finish my NYS next month. I don't want to look for a job. I want to become a full-time trader. People say, I want to leave. I give myself from now to December to master the craft. I will quit my job and I'll become a full-time trader. It sounds good. I mean, I will encourage you. Nice, right? People say, I don't want to be under any boss, but I want to become a full-time trader. And this is the reason why I laugh. I laugh because I tell them, I say, see, let me tell you, when you become a full-time trader, yes, you are not going to be subject, to any boss. You're not going to be subject. You're not going to be a subordinate to any other person. But let me tell you, when you become a full-time trader, do you know you're going to have a boss? And who is going to be your boss? Your boss is your trading journal. Your boss are the rules, the systems you have designed in place in your trading. Those are the things that are going to act as a boss. You are going to subject yourself to your trading journal. You're going to subject yourself, to your trading rules. Those trading rules are going to be your boss. And you know what happens in an office when if you go against the rules that your boss gives to you, you know what will happen. Number one, if they don't reduce your salary. Number two, you are going to be retrenched. Number three, you are going to be suspended. You're going to be suspended. Anything can happen. Anything is likely going to happen, right? So that same thing applies to Forex. Number one, you don't have any physical person that is controlling you or bossing around you, but you have something you wrote in paper, which is called a trading plan. You have rules, risk compliance rules that you want to look at them every morning. You look at your risk compliance rules and look at them every morning. As much as that risk compliance rule is not a physical body that is speaking to you, that is your boss. That is your boss. So you are still an employee to your rules. You are an employee to your, if that's the best word to use, you're an employee to your trading rules, your risk compliance rules. And one of the reasons why people fail in trading is because they don't even listen to their boss. They don't listen to their trading compliance rules. They don't listen to their risk management rules. They don't listen to it. And they just keep failing. And they feel like, oh, why am I failing? Why am I failing? Why am I failing? Number one, you are writing in your risk management or your risk compliance rules. I love to use the word risk compliance, right? So, in your risk compliance rules, you are written that as a developing trader, number one, I want to limit my trading frequency, meaning that for me to be able to maintain accuracy, if you want to really maintain accuracy, you have to be selective, meaning that being selective, meaning that you want to only position yourself in the Forex market when high probability trade shows up. You just don't want to come in anytime. You want to position yourself only when high probability kind of trade sets up. So for you to be accurate, you have to be selective, right? And for you to be selective, you will limit your trading frequency, right? So have it at the back of your mind. Write it as a part of your journal. Day trading is not everyday trading. And so another thing is that one of the mistakes people make, one of the mistakes traders make that mess up with their mental capital is that they turn short-term trades into long-term trades. Let me tell you something I've noticed about myself. And sometimes I feel it is abnormal, but for me, it's just myself, because what trading would do to you in the long run is that trading is going to reveal who you are to you, right? So somebody sent me a direct message. Okay, I'm not going to read it out now. Let me just continue. So one of the things I've discovered over myself is that if I have a setup, I have my weekly outlook with the family, or when I have my personal weekly outlook on Sunday, preparing for the new week. Sometimes my setup doesn't show up on Monday, it doesn't show up on Tuesday. But when my setup shows up maybe on a Wednesday, and I take a trade that goes 1 to 5, 1 to 6, maybe overall it goes 1 to 10, 1 to 12, I just discovered that I feel like I'm content for the day, I'm content for that week. I'm just okay for the week. Don't forget, I said money management is going to do the lifting in the long run. It is going to do the lifting. So does that mean on Thursday and Friday, I'm not going to come on the chat? I will come on the chat, but trust me, I'm telling you, I'm not going to lie to you. I'm being very honest. Thursday and Friday, I would hardly take any other trade. If I get 2 good trades in 1 week, I'm okay. I mean, sometimes I've seen it happen where I have good running trades on Monday and Tuesday, and Wednesday, Thursday, and Friday, I'm not even trading. I'm just marking up charts. Somebody say, look at this, I'm looking at it, but I'm not trading it. I do other stuff. I study books. I study video materials from my mentors.
All right. So I guess that is his network. So let's give him some minutes to fix that. If you've been enjoying the section so far, can you draw something for me in the chat? Wow, great, great, great. So much value is being dispensed. So much value is being dispensed. Trust me. Trust me. These are paid section. Those are paid sections content for you. Trust me, they are all paid content. So great, so great. Mr. John is raising his hand. Do you have a question? Okay. Right. Yeah, guys. So let me see if he's back. I think he's trying to fix his network. To fix his network. I really do hope gets that fixed real soon. And come on, can you guys try to do something for me? Can you go into the group and tell them that if you are not on this call, you are missing out a lot? I want everybody to say something on that group. We are 70 on this call. I want to see some not an emoji. I want 70 comments from each individual. If you are not on this call, you are missing. If you are not on this call, you are missing. If you are not on this call, you are really missing out. You are really, really, really missing out. You are really, really missing out. I do hope he's going to be here soon. Charles, can you please help me put a call through to him to check up? I know where we stand. Yeah, thank you guys. Thank you. I see you all. I see you all. Thank you. Thank you. Thank you. Tell them if you are not on this call, you are missing out. You are missing out. Trust me. In my little world, if you underutilize or if you undermine risk management, then I don't know. It might be as good as anything. And if your risk management is not there, trust me. So you need this risk management call. Every single trader, because most of the time I see what people use call risk management and I'm like, well, what's this? I'm not trying to say I'm better off, but I see what they call risk management and it's something else. Something else actually. So I really hope it's going to be back real soon. Yeah, how are you? Yeah, thank you guys for commenting in the group. Thank you. If you're not on the call, you are missing out. And Nigeria network, we always want to stay in your place. Wow, someone is saying here, my risk management has been so poor and I've blown accounts severally. Well, we all have blown accounts, so I think it's even like a badge. If you are a trader, you have not blown accounts. Then I don't think you started. But then there is a time whereby you need to stop blowing accounts. So after tonight's call, I want to hope that will be one step to not blowing. I'm not saying it will be the final, it should be the last time you blow accounts. I'm saying it will be one step closer to not blowing your accounts because Forex is a marathon. All right, Sport is back. You are welcome. So I'm making the host now. All right, so you can continue. Sorry about that.
So yeah, sorry. Can you hear me? I mean, I'm so sorry. Can we all hear me now? I'm back. I'm back. Can we all hear me? If you can hear me, drop some 8. I mean, maybe an information I was going to change somebody's career just was about going to be dropped, and the devil just felt like, you're not going to say that. My network just went bad almost immediately. I had to switch network. I had to change network. So let's just go into the nitty-gritty right now, because we still have a lot of stuff to do. We still have to talk about liquidity. We'll look at the charts. Yeah, thank you so much. Thank you so much. Thank you for the loan. So let's go into, lastly, I was saying that avoid turning short-term trades into long-term trades. Now, I mean, that is if you are an intraday trader, right? If you know that your risk compliance rule says that you are going for 1.3125 maximum, stay with it. Stay with it and allow money management do the lifting over a period of time, especially, emphasis on the word if you are a developing trader. If you are a developing trader, right? If you're a developing trader, you want to allow money management do the lifting. So now, when you talk about limiting your frequency in trades, it leads us to the points where we now say, okay, proper risk management. Now let's draw a risk compliance rule. Now we say you deposited $100 into your broker's account, and you said you're going to be risking 5%, which is $5. 5% is actually $5, right? So you say you want to be risking 5%. You are developing a risk compliance rule. Then you say your risk to reward, right, is going to be 1:3. Now, what's your risk? Now, as a developing trader now, you have your risk compliance rule. You have your risk compliance rule properly laid out. Now, this risk compliance rule talks about how much you have deposited, how much you are willing to risk, and how much you want to take off the table whenever a trade goes your way. Now, this is your risk compliance rule that you have developed now. Let's say you are writing this down in your journal, and so you have this down, how much you deposited. So then you write another thing. You say, you give yourself, I said, allow money management to do the lifting. So you say time of percentage growth. Let's say we are working with 1 month. You want to see how far, you want to see two things for the time of percentage growth. You want to see how long it's going to take you to blow an account, and how long, like how many percent can you do within a month, right? So now we are working with a time frame of 1 month. Yeah, right? So 1 month, we are working with 1 month. So let's say in that month we have 4 weeks, right? So we have 4 weeks. I'll show you something now. Just follow this. Follow this. So we have the week 1 in the first month. We have week 2 in the second month. We have week 3 in that same first month. We have week 4. So don't forget, you are telling yourself every morning that money management is going to do the lifting in the long run, right? So now, number 1, you said you are going to be risking. You said you are going to be risking. You're going to be risking just 5% of your account. 5% of $10, $100 is $5, right? And you're telling yourself that what you're going to be putting at risk is $5, and what you want to be getting reward is going to be 1:3, which means that if that trade goes in your direction, you are going to be getting 3 times of what you are risking. That is 5 times 3 is 15. Or if the trade goes against you, it's just going to be $5, right? Now, let's now do the maths together. I just need your active participation, right? I need your active participation right now. Somebody said, can I stay throughout the night? Oh my God, I can't. My mom is preparing dinner. I can't. So week 1, now let's do the maths together now for week 1. Now put your mind on the note that I said. Money management is going to do the lifting over a period of time. And the time of your percentage growth, the time you are giving yourself, the development time you are giving yourself as a developing trader, is that you want to give yourself 1 month. That 1 month, you want to see 2 things happen. Number 1, you want to see how, it's just like you are working with the statistics. You want to see how long it is going to take you to blow an account, number 1. And you want to see, number 2, how many percentage increase can you do on your initial deposit? Those are the two things you are working on with. So you have deposited $100 from your risks and compliance rules. You are risking $5. Your risk to reward is going to be 1 to 3, which means that, I told you that people who say they don't want to trade, they don't want to work for anybody, they just want to be, they want to be their own boss. Your risk compliance rule is going to be your boss, which means that you must never go against the amount you are risking. No matter how juicy the setup is, you will never go into a trade without putting, say, okay, this trade is going to go my way, and without using a stop loss. No, your risk compliance has told you $5 is only what should go out when you lose on a trade. So now let's deal with week 1. Let me show you how money management now does the lifting. Now, as a developing trader now, you are putting and finding faith in the strategy that you have learned, smart money. You have learned how to trade smart money, right? So then week 1, let's say you took 4 trades and you lost 2 and you won 2. Now, do the maths. You lost 2, you won 2. Now, the first 2 trades you took, you lost 2. Now, which means that how much has left your account now? $10 has left your account, right? Yes. Now, $10 has left your account, right? Your balance is now going to be what? $90. But that same week 1, you now took 2 extra trades and you won those 2. Don't forget, your risk to reward is going to be 1:3, right? So any trade you win, you are going to be multiplying it by 3. It is going to be 3 times your initial investment. Your initial investment is $5. So now you lost 2, you lost $10. Then when you want 2, how much are you getting now? The first one you won is $5. 5 times 3 is 15, right? Then you won another one, 5 times 3, 15. That is how much? 30. Now, $30 that you made plus your initial balance now of $90 is going to be what? You are going to be left with $120. Are you seeing now? That is week 1. So can you see now that week 1, you ended week 1 even being profitable with a $20 $15. Yeah, I'm recording already. Let's go ahead. Now, in week 2, you lost 3 trades and you won 1. Now, your initial balance is now $120. You have made $20 profit extra on your $100 initial deposit. Now, week 2, you lost 3 trades and you won 1. Now, we are working with the first 3 trades. The first 3 trades you lost is going to be what? $15, right? Now, 15 minus $120, how much are you going to be left with? Somebody put it in the chat box. You are going to be left with $105, right? You are still up $5 profit. Then you want the last trade for week 2. Now, the last trade you want for week 2 is a 1 to 3 again. That is 5 times 3 is going to give you what? 15. Now, 15 plus 105 that is remaining. 15 plus 105 that is remaining. 15 plus 105 that is remaining. You are going to be left with what? How much are you going to be left with? Put it in the chat box. How much are you going to be left with? 120. Now, you are still up $120. Are you seeing now? Now, week. Somebody said 125. 15. 5. No, 120. It's going to be 120. It's 120. Now, let's go. Week 3. You now took 3 trades. Now, the reason why I'm doing 4 trades, 3 trades is because I told you, as a developing trader, you want to limit your frequency. You don't want to be trading, hitting the buy button, sell button every time. Limit your frequency. You want to maintain accuracy. And for you to maintain accuracy, you have to be selective, right? So I'm using 4 trades, 3 trades. So week 3, you took 3 trades, right? You came into week 3, you are still up $20 profit. You came into week 3, you took 3 trades, and you won 2. Now, you won 2, and you lost 1. Now, the 2 that you won is going to be how much? 1 trade, if you win 1 trade, is going to give you 15. If you win 2 trades, it's going to give you 30, right? Now, 30 plus 120 that you have left is going to be 150, right? Now, 150, because you lost 150 minus 5 is going to give you what? 145. So you are up 145. You are up with $45 profit. Yes, 145. Then the last week, because you are using 1 month to check how long, what is the percentage increase you can do on your initial deposit. Then week 4, you took 2 trades and you won 2. You just won that 2. And you didn't lose anything for that week 4. Now, if you win 2 out of week 4, and your remaining balance is 145, how much would you be having left? 2 trades. If you win 1 trade, it's going to give you $15. If you win 2 trades, it's going to give you how much? $30. 30 plus your remaining balance now of 145. How much are you going to be having left? You are going to be having 175. Perfect. So you are left with $175. So at the end of that month, what have you done? I mean, now listen, because you have told yourself in your risk compliance rule, in your journal, that see, I'm going to allow money management do the lifting in the long run. So you're not going to be focused on, you're not going to be, now, in your risk compliance rule, you're also going to state it that it will take 10 trades because you are risking 20%. Then you also state, you say to yourself, you say, see, it will take 20 trades to blow this account. It will take 20 trades to blow this account. Trust me. If you follow the system you have been taught, you are not so dumb that you take 20 trades and lose all the 20. That is, if you follow the system that you have been taught from the beginning, right? So your risk compliance tells you that it will take 20 trades to blow an account, right? It will take 20 trades. So you have it at the back of your mind that it is going to take you 20 trades to blow this account. But now you are not going to be focused on because week 1 now you took 2 losses. You're not going to be focused on the 2 losses. The only thing you're telling yourself is that, oh, I lost 2. I have 18 more bullets. I have 18 more opportunities. Trading is just like playing card. The moment you stick to your risk compliance principle, you are having enough card to play on the table. You are still going to be having enough card to be playing on the table, right? So when you lose 2 trades, you tell yourself, see, guy, I have 18 more bullets. I have 18 more cards to set on that table. I can still play. You are giving yourself opportunity to be able to play this game over and over and over again. Then you win 2, you are back, you are in profit. Going like that. Now you are focused on the percentage growth that you want to do in a month. You are not concerned about the money. Then at the end of that 1 month, you say, oh, then I was able to come out with $175. If you continue with this, let's say you now want to, you just want to have that feel of what it means to make money from the Forex market. You withdrew $25 and spent the $25. You pay tithes, you enjoyed yourself, went to eat, and you left $150. Repeat the same pattern on a $150 account for 3 months and see the compounding effect and see what you are going to come out with at the end of 3 to 4 months or 6 months. You understand? So this is how risk management works, right? So keynotes, I just hope if you are with me, just drop some 222. If you are with me, just drop some 222 in the chat box. Trust me. I really just want this to be, I just want this to be that session. Every session is going to be that session. But I want you to leave here assured that you know what you are doing. I want this session to be a pointer to you that, see, I know where I am making my mistakes already, and you are going to stick to it. You see, right? So as a developing trader, write it in your risk compliance rule and tell yourself, I'm a developing trader. My boss is my trading journal. My boss is my risk compliance rule. My boss is my risk compliance officer, and I will listen to him. Yes, that risk compliance is written in a book and a paper. It's not a human person, in a human form that can speak to you. But if you are not disciplined in adhering to the rules that you came up with, how much more when you are working in an environment? It's not possible. So let's go. This is 10:13 already. I'm enjoying the class already. So, okay, thank you so much. So let's go ahead. This is that for risk management. So you'll get the recording, you'll catch up with the recording, right? So let me just take this off. Then the next thing we want to talk about is I want to talk to you guys about ranges. I mean, this part is even very, very important, right? It's very, very important because it's going to help you to position, to know how to trade, you know, where to buy from, where to sell from. I want to talk to you about ranges. Then next one will be moving to liquidity. So listen, so just write, just write and go over it. Revisit the video over and over and over and just write. So now when you talk about range, my brother who was the educator for yesterday was teaching us, and he was saying something about, he was teaching about discount and premium zones, right? So what really helps you to identify the discount and the premium zones are your ranges. Your ranges. So the first question we want to ask, because of time, a lot of people will be going to work tomorrow, except for those of us that are full-time traders. You want to ask yourself the first question. The first question you want to ask yourself is that, how do I determine my discount and my premium zone? How do I know where my discount and my premium zone is? The subject, the part of Forex that helps you to identify your discount and your premium zone is your range, right? So a range here, a range only exists in the Forex market when we have two data points connecting. When there are two data points that are existing, it is two data points that are existing in the Forex market that helps us to determine a range. Now, for example, if you have in a bullish scenario, now don't forget I said range exists in the Forex market when we have two data points, right? Or we say two swing points, when we have two swing points. So listen, don't get distracted. Anything that is distracting you, anybody that is distracting you is an attack. Let me say it like Apostle Sewa. So in a bullish scenario, you have your low, you have your high, you have your higher low, you have your higher high, you have your higher low, and you have your higher high, right? So now, if you in a bullish scenario, you have your low, you have your high, you have your higher low, higher high, higher low, higher high, right? I said to us that range only exists in the foreign exchange market, the Forex market, when two data points or two swing points are actually existing. Now, your first swing point in a bullish scenario is this low. You were taught about market structure yesterday. This low, the first low here is your first swing point. The next swing point is this. This is your next swing point. Trying to clone this. I'm not using my mouse. Okay, I've been able to clone that. Now, so you have, this is your second swing point. Now, in a bullish scenario, your low or your higher low is your swing point. This is your swing point. This is your swing point. This is your swing point. These are the two data points that are actually existing. Those are the two data points that are actually existing. These ones. So in a bullish scenario, you say, okay, now, because let me tell you, aside money management and every other thing, another thing that makes people, one of those things, newbies, after, people are always caught up with the fever of what they see on Instagram. You see people driving Lamborghini, and you want to kill yourself. You don't want to submit yourself to some learning time, right? So, you see some YouTube mentors will tell you, if it is going up, buy. If it is coming down, sell. No, the way we trade, we want to see the market come to us. You want to make the market come to you. You don't want to be pursuing the market. We don't pursue the market. One of the things we tell ourselves, in my mentor's mentorship is that the market doesn't live without us. Now, the reason why we say the market doesn't live without us is because we have an understanding of what range talks about. We have an holistic understanding of how the market works, right? So we have an holistic understanding of how the market operates. So we tell ourselves the market doesn't live without us, right? So now, one of the ways you will leave this call telling yourself that, see, I have always been chasing the market, and now I don't want to be chasing the market. I want the market to come to me, is by paying attention to what I'm teaching you on range. Now, you want to find your first swing point. I said range only exists in the Forex market when you have two data points, two swing points. Two swing points exist to form a range. Number one, in a bullish scenario now, the low is your first swing point. The high that is formed is your next swing point. Now, the moment you have determined your high and your low, this low here becomes your discount, this high becomes your premium. right? Now, the 50% of this entire range is going to be your equilibrium. It is called the 50%. Now, pay attention to this, because when we talk about liquidity, I'm really going to match up everything to you. So you are just going to see the dots connect as we go. So you would now see that, the first swing point in a bullish scenario is your low. The second swing point is your high. This high and this low has already formed for you your dealing, your trading range, which means that in a bullish scenario, you don't want to be buying at premium. You don't want to be buying at premium. You want to be buying at a discount. So now, the moment your dealing range, your first range has been discovered, right? The moment your range has been discovered, you want to be buying at discounts into premium. You want to be buying at discount into premium. Now, okay, let me use this. I have a tool here that would help us. Now, I also use this tool to determine my range. Now, if you see this particular tool, you will see that we have this list. Oh, sorry, somebody left a message. Who is this? Okay, sorry, I will get back to that. Yeah, so now you would see that this particular tool that I dropped now, it helps me to connect the two data points that are existing. It is called the Fibonacci retracement tool, but I actually had to just edit my own to only the 50%, the 100%, and the 150, and what's the last one? 0, 50, 100. Yeah, so this middle point now, this middle point is the 50%. It is called the equilibrium of the range. This top here is the premium. This bottom is the discount. Now, when in a bullish scenario, when the market is buying up to this point, you don't want to be buying at premium. In a bullish scenario, you want to be buying at discount into premium. The same thing applies here. The same thing applies here. The market is buying. Let's say the market has, sorry, let me just draw this last range. Man, I hope we are getting value, man. I hope we're just getting value, honestly. Now, let's say you missed this first buy move that happened here. And the market, you just came to your chart and you saw the market going to the upside, right? You don't want to be buying at this entire move that is going. You tell yourself, the market never leaves without me. The market will always come to me. I'm not going to chase the market, right? So you have missed this first move. The next move you want to be looking for is the next buy position, right? Now, for you to be able to catch the next buy, right? The first thing you want to determine is what is your next range. Your next range is now going to be this new high, this new low, this new higher low, and this new high. These are the two swing points that are existing in the market, right? So what are you going to do? Don't forget I told you, don't buy at premium, buy at discount. You are buying at discount. So if I use my Fibonacci retracement tool again and mark from this first swing point, swing high, to this swing low. Okay, let me take this one out. Now you have missed this first move. You want to catch this second move, this second buy that led to this point, right? Now you have your two swing points that are existing, your two data points that are existing. This is the first data point, this is the second data point, right? The first data point, which is your higher high, is your premium. You are not buying. I'm putting my hands in my ear and talking, don't mind me. You are not buying at premium. Don't buy at premium. Buy at the discount. That is the best place you want to buy from. And the banks and the financial institution will always leave a footprint for why you should always buy at discount. They would either leave an institutional candle, they will leave an imbalance, those things. My brother is going to teach us those things tomorrow. They are going to leave footprints, and you want to position yourself there. You want to position yourself at that point. You are not buying in a bullish scenario. Don't buy at premium, buy at discount. Then when you buy at discount, what are you doing? You are taking it to premium. Now, listen now. You missed the second move again. Maybe you were doing something, you missed the second move. You want to catch the third move. Now, this new third move has happened to this point. You are not buying because price is still at premium. What are you going to be doing? You want to find price coming into discounts. Now, let me take this out again now. You missed the second move. You want to catch the third move. Now, for the third move, what is your first data point that is existing? This higher low is your first data point. This second higher high that has been formed, this third higher high that has been formed is your swing point 2, is your data point 2, right? That is your premium. Now your discount has been formed. You are waiting for your premium to be formed in entirety and price starts coming down to discount because you have told yourself in a bullish scenario when your dealing range has been formed, you want to be buying at discount into premium. So the next thing you want to do is that, see, first move missed, second move missed, but this third move, I'm not going to miss you. Then you mark out your range again. this is your range. Swing point 1, swing point 2, right? So I use my Fibonacci retracement tool. I mark from that range high, mark it down to that range low, right? So I have my 50%. This 50% is the equilibrium of that range. From this 50% and above is premium. This 50% and below is discount. I don't want to be buying at this. I don't want to be buying at this premium. I don't want to be buying at premium. I want to buy from discount and above premium. So the next thing you want to be doing is that this buy has left you, right? So you are waiting for yourself. You tell yourself, market never leaves without me. Bro, this is what is going to happen. It happens 80 or 90% out of the time. Markets will come into that discount zone again and continue to go to the upside. This is how it works. This is how dealing range works. So the moment you understand market structure, some people left a message. The messages disturbing me. Okay, some people are. Okay, thank you. Okay, thank you. So now, in a bearish scenario, let's talk about the bearish scenario. Yeah, you want to identify your dealing range in a bearish scenario, right? So, in a bearish scenario, you were taught yesterday by my brother that you see the market giving to you lower lows, low, high. It gives you another low. It gives you another high. It gives you a lower low. It gives you a lower high, right? It gives you a lower low. Now, I told us from the beginning that, listen. If you look at what happened in this bullish scenario, you should be able to find out what your dealing range in this bearish scenario is. See, trust me, it's not going to be picture perfect every time you see that the chart, right? But if you understand this, you are going to have, your winning rate is going to increase. You are going to see some level of growth and development in your trading, right? Because number one of the things that this understanding is going to do for you is that it is going to take away you chasing the market. You just come in and you see some impulsive move. Sometimes you see in a bearish move like this, you see market falling like a knife. Have you seen how market falls like a knife before? You just see that heavy move, that heavy momentum, and you see prices dumping hard. And you just say, this market is going to keep selling, and you click sell. The moment you click sell, it's as if your village people are watching you. The moment you click sell, the market will start retracing and start buying. And you tell yourself, you say, oh God, you tell yourself, this Forex is not for me, right? So now, the understanding of dealing range is going to take that away from you. You don't want to be chasing the market. So I told us from the beginning that a dealing range helps you to set to, a dealing range always exists in the Forex markets when we have, number one, we have two data points, right? We have this two data points, that is the data point 1, which is also the swing point 1 and the swing point 2. The swing point 1 in a bullish scenario is the low and the swing point 2 is the high. Now, in a bearish scenario, the swing point 1 is going to be this high and the swing point 2 is going to be this low. Listen. Now, I've told you, I'm giving you rules already. I'm giving you rules that you should apply in your trading. Now, I'm telling you now. I told you from the beginning that in a bullish scenario, you don't want to be buying at premium. In a bullish scenario, you want to be buying at discount. Buy from discount and ride the trade to premium. Buy from discount, ride it to premium. I'll show you live examples from the chart. Now, buy from discount, ride to premium. Buy from discount, ride to premium, right? Now, the same thing applies in a bearish scenario. Now, if I use my Fibonacci retracement tool, that helps me just identify my dealing range properly, right? So don't forget 50%. Now, in a bearish scenario now, this is still my premium and this is my discount. This is my premium. This is my discount. In a bearish scenario, you want to be selling from premium to discount. In a bullish scenario, you want to be buying from discount to premium. Write that down. In a bearish scenario, you want to be selling from premium to discount. Bearish. In a bearish trend, you want to be selling from premium to discount. And in a bullish trend, you want to be buying from discount to premium. Do we get that? Am I sounding too complicated? Please just let me know. Let me know. Am I sounding too complicated? Am I sounding too complicated? Put it in the chat box if I'm sounding too complicated. Somebody said this is very revealing. Thank you so much. Thank you. Man, 72 on the call. Thank you so much, guys. So just stick around. So I'm going to reiterate again. In a bullish scenario, you want to be buying from discount to premium. In a bearish scenario, you want to be selling from premium to discount, right? Anything from 50% and above of that entire range is your premium. See, let me tell you the truth. The banks and financial institutions who are the market makers will always leave a footprint. They will always come back to that discount and premium zones. They would always come back. They will leave footprints. I'm telling you this for free. They will always come back to that discount zone. They will leave a footprint that will make them come back. You must have heard the word retracement, mitigation, and all those stuff. They will come back. They will leave a footprint. Maybe an institutional candle, a smart money cube, imbalance. They will leave all those footprints, right? So in a bearish scenario, you want to be finding yourself selling from premium to discount, from premium to discount. You don't want to be selling from discount to discount. No, you are catching a falling knife. Your risk to reward is not going to be there. Right? You want to give yourself, you want to position yourself in the best place. And let me even say this. I was almost going to skip this. Now, in a bullish scenario, don't forget you are buying from discount to premium, right? If you are buying from discount to premium, right, your stop loss should be at the most recent, your down range. Your stop loss should be at the down range. This is where your stop loss should be when you use your tools. Yes. When you use your tools, your stop loss should be at this low. Then your stop loss should be at the bottom range of that entire dealing range. Your stop loss should not be found inside the range, inside that range. Now, let me tell you something. Be truthful to me, guys. Have you been in a situation where you entered a trade? It was going your direction. It hits your stop loss and later went in your direction for long. Tell me, drop it in the chat box. Have you ever been in that situation where you entered a trade, it hit your stop loss, and still later went your direction for days, maybe for hours or for days, and you are wondering why? Has it happened to you? Yes. A lot of people are saying yes. Now, the reason why is because you are trading, your stop loss is within the range. Your stop loss is within the range. Your stop loss in a bullish scenario should be outside your down range. Right? Now, in a bullish scenario, your swing point 1 is called your down range. Your swing point 2 is called your top range. Swing point 1 again is called your down range. Swing point 2 is called your top range. So your stop loss wants to be below your down range. Your stop loss wants to be below your down range, because anything that will make price come below your down range and closes below, it means that structure wants to shift. That structure is no longer bullish anymore. Structure likely wants to shift, or maybe they just turned that down range to something else, to internal liquidity or something. But most often than not, 90% of the time, this is what happens. Put your stop loss below the down range. Give the trade the time to breathe, and you are buying from discount to premium. And the same thing applies to selling here. You are selling from premium to discount. And your stop loss should be above your top range. In a selling market, your stop loss should be above. It should be above. It should be above your down range and your top range. So now, if you miss, I'm taking too much time on dealing range, but I just want us to, I'm really giving enough this out so that I want everybody to be able to get this properly. People are leaving messages in the chat box. Okay. Why do you want to call my name, sir? Somebody said, I'm not calling your name. I'm just teaching, all right? So, okay. So let's go now. Let's go, guys. Now, if you miss this first selling opportunity that was here, maybe in the morning, you miss that first selling opportunity and you want to position yourself for the next selling opportunity, right? And you already tell yourself, the moment you identify your range, now, your most recent range now for this next move is going to be what? It's going to be this bottom range, this low, and also it's going to be this high. It's going to be this high. This high. So this high is going to be your top range. This low is going to be your bottom range. What did I tell you do in a selling market? Sell at premium into discount. Sell at premium into discount. Sell at premium. Don't sell from equilibrium. Don't sell from discount into discount. In a selling market, you want to catch it from premium into discount. Are you getting me now? So you miss this first move that is happening here. Now, the next thing you want to be doing is that this entire move, this next selling move, you want to catch it, right? Now, you have been able to identify your first range, your top range, and your down range. The next thing you do is that you have been taught that market always comes to us. So you are looking to sell from premium into discount. People are sending messages. Please, what time frame are you analyzing? Time frame, sir. Okay. Somebody said time frame. Like I said, this is not going to be picture perfect on the market. So, but when you go to stuffs like on the daily, 4 hours, 3 hours, your weekly, those time frames helps you identify your most dealing range, your most active or recent dealing range, right? Because the 4 hours, the daily controls the 4 hours. Listen, the monthly control the weekly, the monthly time frame controls the weekly controls the daily controls the 4 hours, the 4 hours controls the 3 hours, the 3 hours controls the 2 hours, the 2 hours controls the 1 hour. 1 hour now controls every other little time frame, like 45 minutes. 45 minutes controls 30 minutes. 30 minutes controls 15 minutes. 15 minutes controls 5 minutes. 5 minutes now controls other time frames like 1 minute and 3 minutes, right? So if you understand your dealing range on the 4 hours or from the daily, it gives you a clearer picture. The daily range from the 4 hours or the daily gives you a clearer picture as an intraday trader. So you want to be finding the most recent range on a higher time frame, like 4 hours. Don't ever pull the trigger against the 4 hours. No, don't ever. As an intraday trader, don't pull the trigger against the 4 hours. No, don't ever do that. So now let's come back to this. In a bearish scenario, you want to be selling from premium into discounts. Oh my God. We're still going into liquidity. And if you understand these things I'm teaching on range, you will get liquidity. For example, you're going to get external and internal liquidity very quick. It's going to be very, very quick, right? So you understand it clearly. Oh, thank you so much, Orlando. Thank you so much, Kasali Adiola. Yeah, God bless you. I appreciate it. So in a selling market, you want to be selling from premium into discounts, right? You want to be selling. Don't find yourself selling from discounts in a selling market. No, you are catching a falling knife. Now imagine. Now we spoke about our risk compliance rule, right? And we want to have good risks to reward. Now imagine you are selling from. Oh God, trust me. Look at this. Now imagine there are two different types of traders on this call. There are two different types of traders on this call. People who are learning, developing traders. One of them is going to listen to everything I've said and apply it by the letter. And you see that person in every of his trade, he would put his stop loss. He will put his stop loss above the top range, and he will sell from premium to discount. Then there are other types of traders they are also a developing trader. Now look at this. What is the risk to reward for this? The risk to reward for this, can you see this 4.6? This is the 4.6. This is the risk to reward, meaning anything that first trader is risking, he is going to get 4 times of it, right? Now, there's also some kind of traders. I already told them, don't sell from discount to discount. Only sell from premium to discount. But they will not hear. They'll say, nothing like that. City boy. They want to form City boy. Tinubu, I'm not a politician. I'm just joking. So they will now come and be selling from discount to discount. Imagine somebody selling from discount to discount, and he puts his stop loss above the top range, and is targeting discount again. Come on. I've seen some traders trade like this, where their risk is equal to their reward. You are risking $5 to make $5. That's not trading. That's nonsense. Carry your money and go and eat fried rice. Enter one eatery, eat your money and enjoy. How would you be risking $5 to make $5? That's not trading. You are selling from discount to discount, and the risk to reward is 1.1. You are risking $5 to get $5. Meanwhile, there is another type of trader who is going to take everything that I'm teaching to the letter and is going to be getting 4.6. The reward of 4.6, meaning if it's risking $5, 5 times 4, that is 20. Come on, guys. Drop some ones if you are following me. I want to be sure. People are asking questions. People are sending private message asking questions. Somebody said, my brother said, go and eat. Yeah, go and eat. Oh, come on. And we have a lot to 10:39, and we have to leave here by 11. And I don't want to keep a lot of us waiting. Oh my God, 72 people still on the call. Sorry, somebody said, somebody left a message. I'm so blessed to be here tonight. Oh, thank you so much. I'm so blessed you're on the call. Blessed for the opportunity. Let's go. So, are we fine with range? I want to move to liquidity. I want to move to liquidity. Honestly, I'm trying to take my time for you guys to be able to understand this. Go over the recording. You know, I said something to you. I said, see, let me tell you, if you are introduced into the aviation school, you don't become a pilot day one. The first day you are introduced into the aviation school, you don't become a pilot when you are handed over introduction to aviation. No, you would go through some process of development. You will go through some learning phase. And at the end of the day, you now become a pilot. The same thing when you want to study medicine. Introduction to medicine doesn't make you a medical doctor. You would give yourself to some, there are some things you would learn by repetition. So you go over the videos. So guys, let's move to liquidity. The recording is going to be in the YouTube channel. It's going to be in the YouTube channel. Thank you. Yeah, YouTube. Now, so write it on your notes. In a bullish scenario, when you know your dealing range, buy from discount to premium. Don't buy from premium to premium. You are catching a falling knife. You are going to get burned. The risk to reward is not going to be there. And another thing you are going to be doing to yourself is that you are going to be what's the right word to use? You are going to prolong your journey to profitability. You're going to really prolong your journey, right? Okay, yeah, Zoe, thank you. So you are going to prolong your journey. So in a bullish scenario, you are buying from discount to premium. In a bearish scenario, you are selling from premium to discount. This way you are going to get good rates to reward. You are going to, so let's move on to liquidity. I hope you are going to, sorry please, I don't want to go. Coach, are you on the call? Okay, let's continue, guys. Now, we want to talk about liquidity. See, the same attention you paid during daily range, just pay the same attention. Listen, just pay the same attention. I'm really going to try as much as possible to make it as simple as, one of the things I always say to myself is that I really want to understand trading to the point where I can explain it to my 6-year-old daughter. I'm not married. I don't have a daughter here, right? But I want to be able to I want my 6-year-old son or daughter to ask me in the long run, Daddy, how do you make money? Yeah, you don't go to work, you sit in the house every day. And I'm like, I make money from sitting at home in my screen. And he says, Daddy, how do you do it? And I say, okay, you want to learn? Yeah. And I explain these things, amplified and simplified, to my 6-year-old son. Now, before my son gets to 12, he already understands how to trade, he already understands everything. So let's talk about liquidity. So what is liquidity? Liquidity is actually the measurement of how many participants there are in the market at a given time. The reason why I don't want to be writing on the screen is because it's going to take Okay. Let me just quickly answer this question. Somebody said, please, coach, please, oh God, please. So Basil said, please, how can we correlate time frame using range? Because a lot of questions are coming in, right? So okay, you know what? I would answer all the questions. I will give room for questions. I will really answer questions. Trust me. I'm trying to collapse time so that people don't fall asleep on this call. I don't want people to fall asleep, right? So, but I'm really trying to give my best and my all, right? So I don't want people to fall asleep. So there's going to be a room for question. Can we have another day just for questions and answer? Okay, that's fine. Thank you, Mama. Shout out to you, Mama, for that day. I love you so much. That's our Mama. So liquidity. I said I don't want to write on the screen because it's going to take a lot of time trying to type and all those things, right? So what is liquidity? Okay, now liquidity is the measurement of how many participants there are in the market at a given time. Liquidity is the measurement of the number of participants that we have in the market at a given time. Liquidity tells you how many people are actually participating. You know, it tells us how active the market is and the reason. It gives us also the reason why the market is liquid. It tells us why the market is liquid. The foreign exchange market is liquid, 24 hours a day and 5 days a week. The reason why the market is liquid 24 hours a day and 5 days a week, it is because of the active participants that we have in the market. It is because of the active participant that we have in the market, right? So now, there is one thing I want to differentiate for you guys clearly. There's a difference between liquidity and volatility. There are two different things, right? There's a difference between volatility and liquidity. Liquidity actually tells us, the number of people that are actually participating, But what volatility does about is it gives us the measure of how drastically a market exchange rate fluctuates over a period of time. It tells us the number of volume that is in that market. Now, not the active participants now, but the volume. Volatility talks about the volume. Liquidity talks about the number of active participants. As a trader, you want to position yourself in a market that has good liquidity and has high volume. You want to position yourself in that kind of environment, in that kind of a trading environment. How do you now position yourself in a trading environment that gives you high volatility and high liquidity, like with high number of people that are actively participating in the foreign exchange market, right? How do you do that? Now, you get to understand that by understanding what we call sessions. There's something called sessions. I'm just going to rush through. Just follow me, right? I'm a pilot. I'm taking you to a journey. I'm going to have a safe landing. Now, there is something called sessions. Now, for the sessions, we have. Okay, let me just type this. For the sessions, we have. No, I'm not sure if I'm going to be able to type this. Okay, we have the Sydney. This is how to spell Sydney. We have the Sydney and the Tokyo. Now, these two makes up then we have the London, the New York. Okay, let me put it like this. We have the Asian session. And the Asian session is made up of the Sydney and the Tokyo, right? So get this off. Put this here. Right. So let me give you this. Now, the Asian session has 21%. Don't take my word for it. Do your research. But this thing I'm giving to you is correct. The Asian session has 21% of all forex transactions. Listen. Sorry, I didn't come with a slide. I didn't do slide. I don't have it. Oh God. So then the London session has 32% of active participants of all forex transactions. Then New York has the lowest. New York has 19%. Don't forget, I said something that there's a difference between liquidity and volatility. A session can be liquid, yet it is not volatile. There is no volume. Now, if you take, for example, the Sydney session has 21% of all forex transactions, meaning we have about 21% among the globe that are actively participating in forex transaction, in the market during the Asian session, then London has the highest number of participants. About 32% of all forex transaction happens within the London session, right? 32%. Then New York has the lowest. New York has the lowest active participants. It just has 19%. But yet, New York is the most volatile. New York is not the most liquid, but New York is the most volatile. Now, why is New York the most volatile? New York is the most volatile because 88.3% of all foreign exchange transaction has to do with the US dollars. Oh my God. New York is not the most liquid, but yet it is the most volatile. Have you, New York sessions open 2:30 Nigerian time. Sit on your chart and look at the chart, how the chart moves 2:30 every day, Monday to Friday. The volume is heavy. New York doesn't have the highest number of participants, yet it is the most volatile. The reason why New York is the most volatile is because 88.3% of all foreign exchange transaction has a relationship with the US dollar, GBP USD, Euro USD, AUD USD, JPY, USD JPY, USD CAD, USD Swiss, USD DAT, USD RAND, USD ZAR, USD this. They have a relationship with the US dollar. So New York is not the most liquid, but it is the most volatile. Somebody left a message. Oh. Okay. Yeah. Don't worry. Question and answer. Somebody said you can hardly hear me, God. Does that mean I've been speaking to myself? Please tell me, have I been speaking to myself? Okay. Okay, clear. So, New York. Somebody said not at all. Somebody said you can't hear me. Okay, my voice is clear. Now, listen, because we are going into liquidity. We are in liquidity now. And I told you, if you understand dealing range, you are going to understand the concept of the types of liquidity that we have in the market. And I'm going to show you all these things. I'm going to piece everything together and show you on the chart. We might not spend so much time on the chart, but I'll show you how it works. I'll show you on live chat, right? So I said liquidity actually talks about the number of participants that we have in the market, right? And there's a difference between liquidity and volatility, right? Volatility talks about the volume, the number of volume that is actually in the market in a particular time. So I told us that, there are three sessions that makes up the liquidity that are formed in the market. We have the Sydney and the Tokyo that makes up the Asian session. We have the London session, then we have the New York session. The Asian session carries 21% of all forex transaction, right? That is, we have 21% of active participants in the forex market from the Asian session. We have 32% of the forex transaction from London. Then we have 19% of all forex transaction from New York. Then I said to us that there's a difference between liquidity and volatility. New York now has the lowest liquidity, meaning that has the lowest active participant, yet it is the most volatile. And the reason why New York is the most volatile, it is because 88.3% of all foreign exchange transaction has a relationship with the US dollar, USD CAD, USD JPY, GBP USD, Euro USD, USD ZAR, USD Ghana cedis, USD Nigerian Naira, USD anything. They have a relationship with the US dollar, which makes the New York session the most volatile, but it doesn't make it the most liquid, right? So what this entire session helps us to do is that the reason why New York becomes so liquid is because the New York session was actually designed to sweep liquidity. There's something that is called liquidity sweep. We are still going to learn all of that. So what the New York session actually comes to do is that it comes to sweep liquidity. The liquidity that was actually built up during Asian session, the liquidity that was built up during London session, then when it comes to New York actually just comes to clear off those liquidity. Then we always say something to ourselves now in our mentors group, that if you cannot identify liquidity, you are going to be the liquidity, meaning that you are going to lose your money. So you want to be able to identify liquidity. You want to be able to identify the liquidity that was formed during Asian, during London, during New York, during Asian and New, all those things. Then by New York, you want to position yourself, right? Or maybe by London or New York, you want to be able to position. You want to, overall, you want to be able to identify liquidity. So the next question we want to ask ourselves is, what are the types of liquidity? What are the types of liquidity? Types. Types of liquidity. We have static liquidity. Types of liquidity. Oh, sorry. Spelling it right. Now, types of liquidity, we have number one, we have static. You know, when they say something is static, it means that it is not moving. Then we have another type of liquidity that is called dynamic. We have another type of liquidity that is called dynamic. You know, one of the things I always tell myself is that, I mean, I'm just speaking to myself right now, but you know, I always tell myself that, oh, sorry, listen, I'm going to, let me just I'll put this here. I'll put this to here. So now, a static liquidity is a type of liquidity that is not moving at all. One of the things you will learn from YouTube mentorship is that they'll tell you buy at support, sell at resistance. Now, when a market is not moving at all, you will always find a static liquidity in a consolidating market. Pay attention. Yesterday you were taught on market structure. I'm putting everything together, I'm piecing everything together, you know, so that you will have an holistic view of market structure, range, and liquidity together, right? Then when you go back, you should be able to come out with a concrete plan on how you are going to approach the market, right? So in a consolidating market, you will see that liquidity is being built up both at the buy side and also at the sell side, right? A static liquidity, when you say something is static, it means that it is not moving. It is not moving. And you know, the banks and the financial institutions actually do these things to engineer liquidity. They always engineer liquidity at the top and also at the bottom. So when you go on YouTube, you say, I want to learn how to trade. They'll tell you buy at support, sell at resistance. Buy at support, sell at resistance. But what the banks and the financial institutions are actually doing is that they are engineering liquidity. They are inducing buyers and sellers. Now, a static liquidity looks like this. Now, this is a static liquidity. Now, people will tell you, you know, they'll say buy at support, sell at resistance, you know. Let me tell you how liquidity is being engineered. In a static market, in a market that is actually consolidating, because you will always see static liquidity in a consolidating market, right? Now, in a market like this, people are selling at resistance and buying at support. Those who are selling at resistance are putting their stop losses here. They have their stop loss here. Liquidity is money. Liquidity also means stops. It means money, it means stops. So those people that are selling above the resistance, they have their stop loss above. Those that are selling, those that are buying below support have their stop loss below. They have their stop loss here. So what are the banks doing? They are engineering liquidity at the top. They are also engineering liquidity at the bottom. You don't want to find yourself caught up in this thing, because heavy volume can come into the market and you just see they'll take out the buyers, they'll take out all this money that is resting here, and at the end of the day, maybe you were trying to buy, you'll see them now later going in your direction, but they took your stop loss out. Why? Because you were in an environment that was not conducive for trading. You were in an environment where liquidity was being engineered. Oh my God, we have 2 minutes left. Well, we have 2 minutes left. Can you guys hear me? Please. People are complaining that they can't hear me. Coach, I don't know. People are saying that they can't hear me. I don't know if I'm the only one. Okay. Okay. So, okay. 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 Coach, Coach, is Coach on the call? Okay, sir, somebody said, can we have 30 minutes more so that we just round off? Somebody said, let's do it till 12 a.m. It's not me, it's people. I want to adhere to the rules. I mean, I don't want to go against the rules. I tried as much as possible. Okay, we can have another. Yes. We have another call by 12. Okay, by 11:30 we should be done. Yes, sir. We need to rest before the call. Okay, coach, in 30 minutes we'll be done. Yes, 30 minutes. By 11:30 we'll be done. Okay, so now you are finding yourself in an environment that is not conducive for trading at all. This is a static environment. It's a static liquidity is being built up. Right now, dynamic liquidity, I'm just going to rush it now, but I'm not going to miss out the important information. Right now, dynamic liquidity is found in a trending market. Dynamic liquidity is found in a trending market. For example, you will find a dynamic liquidity in a selling market. You find dynamic liquidity in a selling market in this kind of scenario. You'll find dynamic liquidity in a trending market. Low, high, low, high, low, high, low. Look at all the dynamic liquidity that was being created. This is it. When you say something is dynamic, it means it is moving. That is what it means. Now, there are also people on YouTube that will tell you that the moment it touches that trend line 1, touches it 2, that second one is a confirmation, enter the third one. Now, dynamic liquidity is being engineered. It's been engineered. This is dynamic liquidity. You will always find it in a trending market. Oh, this is even a perfect example. Look at this. Now, look at this example we used on dealing range, right? Look at the dynamic liquidity that was being built up from bottom to top, right? Then look at the dynamic liquidity that was being built up in a selling market from bottom to top again, from top to bottom. This is a dynamic liquidity. This is how a dynamic liquidity looks like. Now, let's move to the third one. We have what we call external liquidity. There's something called external liquidity and internal liquidity. I'm going to explain external and internal liquidity very well, right? So let's put this here. Oh my God. Don't forget what I taught you on range. Buy from premium, from discount to premium in a bullish market. Sell from premium into discount in a bearish market. Now, we want to talk about external liquidity and internal liquidity together. We want to use one stone to kill two birds. Now, if you remember, I said something to us. I drew these things here. The reason why I drew this here, I always say to myself that a static liquidity and a dynamic liquidity is actually a target. I see them as targets that the banks and the financial institutions will likely still come back for. Right now, what can later happen in the dynamic liquidity is that, we can have a shift in structure, right? And they'll just come up and clear. This entire move here has cleared all this dynamic liquidity that was actually built up. Now, when heavy volume comes into the market, they can clear all these buyers here, clear all these sellers here, and then have the anticipated direction that they want to go into. Right? So I see static liquidity and dynamic liquidity for me as targets. Then external liquidity and internal liquidity, I see it as a tool. An understanding of external and internal liquidity helps me to position myself properly. Then that is where we're now going to incorporate what I taught in range, dealing range, understanding your dealing range. I see external liquidity and internal liquidity as something that would help me position myself properly in a buy scenario or in a sell scenario. Now, in a bullish market, your external liquidity is always found at the high, your most recent high. This most recent high is your external liquidity. Your internal liquidity, oh my God, pay attention, guys, pay attention. Don't allow anything to distract you. Listen. In a bullish scenario, your external liquidity is always found. Your external liquidity is always found at the recent high. It's always found at the most recent high. Your internal liquidity is always found 50% and below. Oh my God. Okay, let me draw the range. Now, let's incorporate range into external liquidity and internal liquidity. Now, our range for a bullish scenario shows us that this is our most recent low, our swing point 1, or something I call data points. Then this, our top range, right, becomes our swing point 2. Now, I told us that when we are able to identify our dealing range, right, in a bullish scenario, we want to be buying from discount into premium, right? We want to be buying from discount into premium. Listen to this. It will help you. Listen, pay attention now. I told us when I was explaining this range that in a bullish scenario, you want to be buying from discount into premium. You don't want to be buying from premium. You are catching a fall. It's just as if you are putting yourself in front of a train or a trailer. In a bearish scenario, you don't want to be selling from a premium to, you want to be selling from a premium to discount. You don't want to be selling from discount to discount. You are catching a falling knife and it will hurt you. So now in a bullish scenario, now we have our dealing range, right? Our top range, our bottom range. Then I already told us that 50% of that entire range is our equilibrium. 50% and above of that range is the premium. 50% and below is the discount. External liquidity is always found at the top. External liquidity is always found at the top of at the top range, which is your most recent high. Internal liquidity is always found 50% and below. Oh my God. Now, this is not the tool I'm going to use now. Listen, this is the tool I'm going to use. Oh my God. I hope. Now. Yes, this is what you use. Now, don't forget, this is 50%. I told us 50% is just going to be the equilibrium of that entire range, right? This is it. 50% is that equilibrium. Internal liquidity. External liquidity is your top range. It is your most recent high that is your top range. That is your external liquidity. That is where external liquidity is resting. Your internal liquidity is resting 50% and below. Listen, 50% and below in a bullish scenario, then 50% and above in a bearish scenario. Your external liquidity is always going to be resting from 50% and below. 50% and below. It now tells us, don't forget, if you refer to what I said during ranges, that buy at discount into premium. Now, 50% and below is what? Is that not discount? That is discount. That is where your internal liquidity is resting. You want that internal liquidity to be swept. And the moment, listen, the moment your internal liquidity is swept, this is a rule that governs external and internal liquidity. There is a rule that governs it. The rule that governs external liquidity and internal liquidity is that if your external liquidity, okay, let me draw internal liquidity here. Your internal liquidity is always found 50% and below in a bullish scenario. 50% and below. Your external liquidity is the liquidity that is resting above your most recent high. Your most recent high is your external liquidity. The rule that governs external liquidity and internal liquidity in a bullish scenario is that the moment your internal liquidity has been swept, which is at discount, you now have the permission to go and sweep external liquidity, which is at premium. Can you see how these things are coming together? Are you seeing how these things are coming together? People are leaving messages. Are you seeing how these things are coming together now? 50% and below. That is where your internal liquidity is resting. And that is your discount zone. That is the place you want to be looking for buying opportunities. Now, the rule states that until internal liquidity is taken, you don't have permission to come and take external liquidity. Until internal liquidity is swept, once internal liquidity is swept, we now have the permission to go and sweep external liquidity. Oh, come on, guys. Come on. Listen. Now, let's use this. Let's use the second move as an explanation now. Look at this second move. Look at this second move. Look at this second move. Your external liquidity is your most recent high. Your internal liquidity rests at 50% and below. Now, let's say we don't know our internal liquidity yet, but we are able to identify our dealing range. Our recent dealing range is now going to be this low. Our dealing range is going to be this high. Now, in a bullish scenario, you want to be buying at discount into premium. Now, if you use your Fibonacci retracement tool from bottom to top, the internal liquidity rests at 50% and below. 50%, guys, come on, 50% and below. Is that not still your discount? 50% and below, that is your discount. And the rule states that the moment internal liquidity, which is at 50% and below, is swept, you have the permission to now go and sweep external liquidity. The same thing happens in a bearish scenario. The same thing. Come on. Come on. We have 20 minutes more to go. We have 20 minutes more to go. 20 minutes more to go. 20 minutes more to go. And we have one more topic. Imbalance. We can't continue tonight. I mean, I'm so sorry. I'll speak with my mentor, and maybe my brother who is coming tomorrow is going to take imbalance and quarter points. Right. So because I really wanted to just invest my entire time explaining this to you. So let me take this out. Oh, okay. So listen to this. Yes, I'll show you on chat now. That is what I want to even do now. 50% and below is your discount zone. That is your internal liquidity. The moment your internal liquidity is taken, you have the permission to go and take external liquidity. Now, let's go to the charts. I'm going to delete all of this. We have 20 minutes more, so let's go to chat. This is one of my favorite peers, GBP. Honestly, it's one of my favorite peers. So just follow me. I'll show you how this thing works. I'll show you. I'm really going to show you how it works. Somebody will say, let's work with past data. Okay, let's work with past data. If that is what you want, then we'll now work our way down into recent data. Listen to this. Now, this entire move, every forex trader is like a weather forecaster. As a forex trader, you're a weather forecaster, right? What does a weather forecaster do? It looks at the left, it looks at previous data to be able to forecast the future occurrence, right? Now, if you look at this present data here, we see that we're bullish. But if you look at this most recent data now, you will see that we are bearish, right? Now, we are bearish. We want to first identify our swing points. To know where we are buying from and we are selling from. Don't forget, I said in a selling market, people are leaving messages. Okay, somebody said they are saying it. Okay, somebody said he just joined. Sorry, I'm so sorry. We're almost done. I'm going to be done by 11:30. I've actually extended my time thanks to my mentor for giving me the opportunity to be able to do this. Really, right? So now you want to be looking at where am I going to be selling from? So the first thing you want to be doing is that where is your swing point? Where is your swing high and that swing low? The first thing you want to do is you already put market structure in place. Structure is bearish, as we can see. The next thing you want to do is your range. Right? Now, where is your first swing point? This for me is my first swing high. This is a 3 hours time frame. Don't forget I said you don't pull the trigger against the higher time frame. This is your first swing point. This is my last swing point. You use the wicks to determine your range, not the body of the candles. Now, this is my second swing point. What did I tell you? This second swing point now in the bearish market becomes our external liquidity, right? Now, I told us that, let me do this now. Ah, no. Sorry, hold on, just give me, my network is slow. Yeah, this is it. This is what I want to use. Listen, 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 listen. Draw your Fibonacci retracement tool from top to bottom. What do you see? 50% equilibrium, 50% and below in a bearish market, discount, 50% and above, premium, right? Your swing high, your swing low. What do you see? We are buying. I told us that in a bearish market, you want to be selling from discount. You want to be selling from premium to discount. Now, I told us that internal liquidity will always rest from 50% and above in a selling market, or 50% and below in a buying market, right? Where is our 50%? Is this not our 50% here? Is this not 50%? 50% and above, is that not your discount? Is that not your premium? Look at, we are selling from, can we all hear me? Okay, now 50% and above is your premium. And I told you when I was teaching on ranges that you want to be selling from 50% from your premium into your discount. Don't forget now, this is your external liquidity in a selling market. This is your external liquidity that is resting here. What is the rule that I taught you? I taught you the rule that until your internal liquidity is taken, once your internal liquidity is taken, then you have the permission to come and sweep external liquidity. Internal liquidity is resting at 50% and above. This is 50% and above. And external liquidity is your most recent low. Was this low not taken after the internal liquidity? Let's go into a much higher time frame. I want to show you something now. Yes, it gives us more picture. Listen, this is your internal liquidity. This is it. 50% and above. 50% and above is your internal liquidity. What did they do? What did they do, guys? They swept internal liquidity and attacked. What do you see? What do you see? They attacked external liquidity. What do you see? What do you see? Now, somebody will say, it's not so clear. I didn't get it. Okay, fine. Let's work with a much more smaller swing points. Let's work with a smaller swing point. Let me take you to the 3 hours. I want to look for a smaller swing point, something that you would, something that would be fine for you to work with. Let's see. I want to work with a smaller swing point. Now, this is it. We are still in a selling market, right? Now, where is our swing high? This is our swing high. We're identifying our range first. We're identifying our swing low, right? The next thing, we are drawing our Fibonacci retracement tool from top to bottom. We want to identify, next thing is our internal liquidity. Look at internal liquidity. I told you, in a bearish market, you want to be selling from premium into discounts. External liquidity is resting here. This is your external liquidity here. This is it. Come on. If you paid attention to range, you should get this. And I told you that your internal liquidity is going to be resting at 50% and above. Is that not premium? You want to be selling from premium into discounts. Look at internal liquidity swept. What did they do? Hindsight. Click. What did they do? They attacked external liquidity. Are you seeing something now? 50% and above. 50%, when I was explaining range, I said is your equilibrium. Anything from 50% and above is your premium. Anything from 50% and below is your discount. And in a selling market, you want to be selling from premium to discount. You don't want to be selling from discount to discount. Can you see immediately they swept external liquidity? Did you see how they fell? Can you see how this market fell like a knife? It fell heavily. Imagine somebody selling from here. Where do you want to put your stop loss? Even if you sold from here and they still went your way, the risk to reward is not even there. But imagine somebody who is selling from this point where internal liquidity was taken and they attacked external liquidity. Come on. Come on. Are you seeing what I'm showing you? Somebody will say, I want to see recent data. This is recent data. I'm showing you recent data. Yes, coach just said we cut this move. Yes, we cut not just this move. We cut this first move here from this first point, this one down. Then this week we cut this one down. And coach, you also sent this reaccumulation here from this part here. We are looking to buy it up again, right? So we cut it. Yes, my coach just reminded me. Yes, coach, you can help us send it before. You can help us send it before. Come on, see. If you listen to this thing I'm telling you, see, somebody say, sir, can you show us recent data? Okay. I'm sorry. You have to catch up with the recording. We have 10 more minutes to go. We have a meeting with our mentor by 12 o'clock, and most of us who are on this call, the educators, those of us that are on the platform, we want to rest to catch up with the meeting by 12. So we have 10 more minutes. The video recording is going to be dropped on YouTube. Do well to catch up with it. So I want to show you recent data. Somebody say recent data. Let me show you recent data. EU. Euro USD. Come on. I want to show you. Okay. Let me show you something. Let's work with a higher time frame. Okay. We just used a bearish scenario. So let's work with something like a bullish scenario, right? Let's use a bullish scenario now. Look at this bullish scenario. Message. Please, what's the name of the YouTube channel? Yes, I'll drop it for us. Don't worry, I'll drop it for us. Now, look at this move. Look at this. It happens. Listen, it happens. Hindsight. Listen. What is your most recent range? This is your dealing range, the low. This is the high. This is the high. Your external liquidity is what is resting above this high. This is your external liquidity that is resting here. Now, if you draw your Fibonacci retracement tool from bottom to top, come on. 50% is equilibrium. This is the equilibrium of the entire move. I love to use this tool to indicate my equilibrium. This one, this blue tool. I love to use it to indicate equilibrium. This 50% is your equilibrium. And I told you when I was teaching on range, I told you something. I said in a range, in a bullish market, when you identify your range high and your range low, you are buying from discount into premium, right? You are buying from discount into premium. Now, in a bullish market now, your most recent high is your external liquidity that is resting here. This is your most recent high. This is your external liquidity that is resting here. What did I tell you? Buy from discount into premium. And I told you that in a bullish market, your internal liquidity is always resting at 50% and below. What did price do? Come on. What is this? This is 50%. What did they do? It came below 50%. You look for your external liquidity, internal liquidity here. Maybe if we go to a 3 hours time frame, you'll see that internal liquidity safe. You see it. I'll show you. I would show you. Come on. I'll show you. Stick around. Stick around, kid. I'll show you. Come on. So 50% and below. Oh, can we go so far that can we have a lot of data like that? Okay. If we go so far, our data is going to be so big. I can't find it myself. Yeah? Where are we? Okay. Here we are. Listen, 50% and below is your internal liquidity. We have your internal liquidity resting below this point. If you scale through, because of our time, if you scale through to a much lower time frame, you will see that internal liquidity that is resting below here. What is 50% and below? Equilibrium, discount. What is the rule I told you about internal liquidity and external liquidity? Once internal liquidity has been attacked, the next thing they are going to attack is what? Hindsight, they are going to attack external liquidity. They did not attack it here. Look at it. They attacked it externally. They attacked internal liquidity. Look at, come on. Now, let's now move to the most recent range. Come on, last example, maybe. Look at the most recent range. Come on, just follow me in a buying scenario. Our swing high, this is our swing high. This one, this is our swing low, sorry. This is our swing high. Come on, see. Your most recent high is your external liquidity. That is where your external liquidity is resting. Draw your Fibonacci retracement tool from bottom to top because you want to be buying from discount to premium. Oh God. Listen, this is, get this, guys. Get this, get this. Get this. You'll get this. Trust me, you'll get this. Go over this video again, you'll get it. Listen. Now, I told you that 50% is the equilibrium of the range. Okay. Maybe some people would actually get it more if I use that first fib I used when I was explaining range. Now, I told us that this entire, can you see now how it lines up? Can you see how it still lines up with it? Can you see now? 50%, this is your equilibrium. 50% and above is your premium. 50% and below is your discount. I told you that you want to be buying at a discount into premium. And your external liquidity is resting above the most recent high. Your internal liquidity is resting below 50%. Where is it? This is your internal liquidity. Was it attacked? You can take this. You can also take this. Let's take this. Was it attacked? Yes. What is the rule that governs internal and external liquidity? I just told you. Once internal liquidity is swept, you have now the permission to go and attack external liquidity. Did they attack it or not? Come on, come on. Did they attack it or not? Here we go. Was it attacked? Come on. Come on. How did we sell from here to this point? Swing high, swing low, 50% and above. We sold from premium into discount and we are still selling. Come on. Come on. I mean, 11:26. 11:26, guys. 11:26. 11:26. Drop some ones in the chat box if you are following me. If you got so much value, drop some ones in the chat box. I feel like eating. Thank you. Oh, some people. Come on. Come on. Come on. Come on. Listen. Listen. Look at, I want to show you recent data and I'll close with this. I didn't catch this, but my mentor caught this. Coach Philip caught this. My mentor caught this. Listen. What did I show you? Listen. This is a lower time frame, 15 minutes. Your range, swing high. This is today's move. Swing low. We have our range, 50%. Listen, I'll show you. I'm going to show you. Trust me. 50% is the equilibrium of this entire range. And you want to be selling from premium into discount. Don't forget, this is where your external liquidity is resting. Outside here, your external liquidity is resting. That is your down range, right? Internal liquidity is always resting at 50% and above. Come on. Where did price sell from? Price sold from 50% and above. It sold from premium, sold into discount. Let's say you missed this first move when I was explaining range. How would you have caught this second move? Range low, range high. Come on now. I'm going to say this. Pause the video. If you are going to be watching the recording, pause the video. What do you see? What do you see? And you say, yeah, from here, they sold from 50% and above. Shoo. Yeah, sorry. High. Swing high, swing low. Use your Fibonacci retracement tool again and put it from the top of that swing high down to the bottom of that swing low. What do you see? Come on. For those of you watching the recording, what do you see? Sold from premium into discount. When they attacked internal liquidity, what did they come to attack next? External liquidity. They attacked it. They would always attack it. That is the rule that is governing it. You see why I told us that those people who say, I don't want to work under somebody. I want to be my own boss. Come on. Your trading rules are your boss. This is your boss. This is what is governing you. And if you don't listen to it, you are going to step on the wrong side. You will lose a lot of money. Internal liquidity, 50% and above premium, and they're sold into discount. Didn't I mention that during introduction to ranges? I told you to listen, and if anybody is distracting you, it's an attack. Somebody from your village doesn't want you to learn this. They don't want you to sponsor the gospel. They don't want you to give millions to the gospel. They don't want you to be a blessing to humanity. But come on, I'm speaking. Listen. 50% and above, premium, 50% and below, discount. They attacked internal liquidity, 50% and above. Where did they go next? External liquidity. Right side. If you're watching the recording, pause the video and see it out yourself. Thank you so much. I mean, it was quite an educative one. I myself, I also learned. People are leaving a lot of messages. Can I just see your message? I'm so sorry about your entry. Yes, not me. My brother Charles is on this call. He's the one that's going to handle all of that. That guy, trust me, that guy is a badass. He's a badass trader. I mean, he's one of those persons that has actually inspired me. He's on this call. His name is Charles. He's on this call, and he's one of those persons that has actually inspired me in my trading journey. I mean, he's my brother, my friend, and it's just a gift that God has given to me, right? So, and I love him so much. So, thank you so much. I'm going to pass the host now to my coach. Thank you, boss. Can you drop the instrumental background music of STF Telegram page? Huh? I don't understand what you mean. Instrumental background music. Can you drop the background music on? Okay. Oh, I get. Yes, I love Chinese music. It helps me to meditate, and also just cool sounds and all. Coach, I want to pass the host to you, and I want to stop sharing my screen. Thank you so much. I really appreciate. God bless you. Such an honor to have every one of you. We started with about 76 or 77 people on the call, and we have about 51 people still standing. Thank you so much for staying this long. I mean, we gave a lot of value for free, and you guys gave us your time, your effort, and your attention, which I'm really, really grateful for, and I do not take for granted. And I want to use this opportunity as well to still appreciate my mentor, my coach, Coach Philip. Thank you so much for this opportunity. Thank you for being a blessing to humanity and for blessing mankind. Thank you so much. And every one of you, drop in the chat box. I'm going to make you proud, Coach Philip. Drop it in the chat box that I'm going to make you proud, Coach Philip. Drop it. God bless you. Coach, the key to us right now. Coach Philip.
All right. Was that a section or what? Well, I told you guys yesterday that tonight's section was going to be hot. You thought I was joking. Well, I really don't want to say so much, but please, guys, do me a favor. Can you put in the bootcamp group something how tonight's section was, and make sure people anticipate tomorrow's section. Tomorrow is going to be yet better. So I really need you guys to put something in the bootcamp group. I really need you guys to put something like from tonight down to tomorrow night section. I want you guys to actively engage on the bootcamp group and make sure you are telling somebody the group, we are ready, we are ready, we are ready. Please let the group be lively. All right, so thank you for your time. Thank you for the opportunity to bring this education to you. Thank you, Fort. Thank you. Thank you, my coach. Thank you, mentor. Thank you. Thank you. Thank you. Don't worry, we'll settle the rest. All right, so Fort, I'll need you to stop the recording now.